Well, good morning. I appreciate your taking some time out on such a wonderful day. I always wake up in the morning and blessed that I'm living in the United States of America and have had a nice life, and we got this kind of technology that we can share things with people, and just feel really, really lucky. So I'm sitting in my home in Santa Cruz, California. By the way, the panel that I have here can even tell me if you're looking at the GoToWebinar as your primary screen. So I can see all of you multitaskers who have gone away to answer your emails and do other things. So I'll call on you, or I'll call out to everybody and tell you who you are. So anyway, enjoy this session. We're going to keep it to the 30 minutes. Looks like everybody's listening on their computer on voice over IP as opposed to having called in. That's fine. That's free, of course. So let me get started here. This is part of our ongoing series of webinars in 2011. We'll be doing this frequently. Even though we have some live quarterly meetings, this is a great way just to cover a topic very quickly and to get some points home. And you can do it sitting, sitting in your room. Here I am in a nice shirt. I thought a webcam was going to be on, but with no pants on. No, I'm teasing. I'm fully dressed. So let's get started here. I have muted everybody. I attend all these webinars, and then I hear 4,000 people all asking other people questions. So we're going to keep it down to our time and let you get back to the business of selling retirement plans and referring them to our company, of course, to be the TPA. So due to time constraints, I'm not going to take any questions. But if you have any questions on the subject, or if you got any other questions about selling 401k plans, just write JD at jd.carlson@plandesign.com. That's not me. I am Paul Carlson, the original founder of Plan Design Consultants. You can write me as well. I'm paul.carlson@plandesign. And on the last slide, I'll give you contact information for our vendor analyst and our people who support you in the marketing of plans. The Plan Design Consultants, the firm behind the 401k Academy, we're a third-party administrator in San Mateo. We've been around for just a mere 36 years. We've got a staff of about 22 people, and we really pride ourselves in the quality of our work. The Academy is a website of resources for you. It's easy to find at www.401kacademy.com. It's also got a blog on it that's informative about marketing of plans. And then we also sponsor these webinars. We've had two recently. On September 28th, we did a plan analysis approach showing you how we can get multiple proposals for you and then analyze that compared to the prospect's current arrangement and do a nice slideshow and go with you to a point of sale. On October 12th, we talked about the open architecture approach. Certainly not the only thing we promote. Fact is, we do all of the standard plans that or platforms that you might be interested in. This one, of course, is about ETFs, exchange-traded funds, in 401k plans. We have another one coming up November the 9th about financial advisor compensation in the 401k world. And then November 16th, we're going to do one on creative 401k design, issues like using QACA, or qualified automatic contribution arrangements, as opposed to the normal basic safe harbor, as a way for the employer to save money. We also, in addition to the webinars and the website and everything, have our live quarterly meetings. So we'll have our fourth one of the year. It's part of our theme this year about it's game time. This is Tariq Jones and Chad Johansson. They're the couple fellows who can work with you on proposals and vendor analysis. This is JD, my son, who's now the CEO and primary motivator of the company. And then I'm the old man here with the gray hair talking to you today. So anyway, we'd love to have you join us at the at the American Century campus in Mountain View. Normally that runs from about 9 o'clock to 3 o'clock, and we let you out about 1 o'clock if you need to, and then the session from 1 to 3 is really just a down and dirty working session of anything you want to cover. Let's take a quick look at the 401k Academy website. If you wanted to register for the seminar, let me get it over to this screen here. So this is what the Academy website looks like right now. If you wanted to register for that fourth quarter seminar in Mountain View at the American Century campus, you can click right here on click here to register. If you want to register for the upcoming webinars on the subjects we talked about, and keep your eyes on this because we'll be developing and announcing more. We'll only put about 4 or 5 up on the website at any given time. You can, if you have forgotten how to reach us and you have a prospect and you want some help, you can go to 401k Academy. Hopefully you can remember that, and just click on Sales Support. And you've got the phone numbers and the direct dials and the emails for Chad and Tariq. You can always reach JD as well. On the website, you'll find a lot of materials designed for advisors. For example, the retirement plans limitation chart. The government just recently announced what the new limits are for 2012. So I'm bringing those up on the screen. If anybody's having trouble seeing the screens or whatever, if you'll let me know through the chat bar or the question bar, that would be great. But anyway, let me maximize this. So what are the limits for 2012? The salary deferral limit has been adjusted to $17,000. The 457 is $17,000 as well. The over age 50 salary deferral makeup contribution has not changed. That's still $5,500. So the total of the two now would be $22,500 if you're over age 50 by the last day of the year. In defined benefit plans, the amount you can promise yourself at retirement, if that's less than 100% of your pay, is $200,000 a year. The overall limit on annual additions to a 401k plan is $50,000, but you can add the $5,500 if you're over age 50, so $55,500. And the amount of compensation we can count is $250,000, whereas last year it was $245,000. So people need these numbers all the time. It's even got some information on here about when do you phase out for IRAs and so forth. Okay, and then finally on the Academy website, you should go there occasionally and check our blog. On the blog, we've got a lot of useful information. We try to have marketing ideas for you, such as we've got one there now about approaching clients who have a basic safe harbor and tell them that they ought to go to a QACA, a Qualified Automatic Contribution Arrangement, as a way to save money. We do things such as come out with the IRS limits as soon as they were published. We got some information about dripping. We've got small employer ideal design, all updated for the 2012 limits, and things of that nature. So a lot of material on the blog. We try to keep it current. We try to keep it helpful to you. We've also got on the website our primer on 401k plan alternatives. It's about an 8 or 9 page 401k fundamentals. If you're kind of new in the retirement plan area and you want to add it to your book of business and you want a really good primer, of course I wrote it, so I think it's a really good primer on how the ADP tests work and what the alternatives are for safe harbors and so forth. Be sure to click on that. So enough on the website. Let's get on to the subject of ETFs in 401k plans. And again, I'm Paul D. Carlson, or Paul Carlson. This little icon here is one I put on here to remind me to engage in what we call a poll. So I'm going to do a poll right now, and I'm going to launch a poll, and you're going to then answer it on your computer, and then we're going to see how the responses came out. So I've got this first question, which is, I believe ETF options are essential to a quality 401k plan. So I believe ETF investment options are essential to a quality 401k plan. So if you could just take a second and do your answers. No, not really at all. Yes, very important, desirable, but certainly not essential. No opinion. That's why I'm attending the webinar. So, so far I got 87% of you have voted. 93% of you. All right, who's out there talking on the phone and not attending the webinar? So we'll go ahead and close the survey with 93% of you having done it, and then let's see how you all feel as an audience. So I'm sharing that with you. Can you see it in your panel? I'm hoping that over in your panel you can see it. I'm going to drag it over here just in case you can't. So, none of you said no, not really needed at all. 7% of you said yes, very important. 64% said desirable, but not essential, and 29% of you have no opinion. So, kind of interesting before we start the seminar that okay, it seems to be like an okay thing, but certainly not the end of the world the way this group sees it. So let's go on. So the question is, why should you be aware of ETFs in 401k plans? And I'm not sure I see a valid view of the world in that I see things and I'm focused on them. I'm not sure if the world in general is seeing a great big demand for ETFs, but we certainly are having more and more plan sponsors asking if there are ETFs available in the plan, and plan participants are also asking. Why are they asking? Well, similar to the trend and the phenomena of everybody demanding, Vanguard index funds. They basically read a lot of articles in the Wall Street Journal or Money Magazine, or they see something on TV and everything tells them that your 401k plan is broken if it has any fees associated with it, if it has any kind of commission for anybody, and your 401k plan is broken if it's not just using, passive index funds at 19 basis points expense. So people read that, believe it, and don't understand the real world. If you got a 20-person plan with $500,000, that there has to be some compensation in there somewhere, certainly for you guys as advisors and for us as TPAs. So anyway, articles are written, people read them, and therefore they ask for them, whether they understand them or not. So what do you do as an advisor? Do you tell them they're stupid and that they shouldn't want it? If you feel that way, well, I think not. I think what you do is you watch trends, and if you want to be on the front edge of things, you see which trends are growing and where the demand is, and then you try to position yourself to be able to supply an answer to that demand or to that trend. So I certainly think you should become aware of exchange-traded funds in 401ks, become educated about them, and then be able to deal with them. Okay. What is it? Well, it's obviously exchange-traded. It's traded on a stock exchange. So it's an investment fund traded on a stock exchange. There have been lots of them have been created now that are either stock-based or commodity-based or bonds, or there's even things called exchange-traded notes. So many of the ETFs track the various indexes, a wide variety of indexes. They combine the valuation feature of a mutual fund but with the tradability of a closed-end fund, meaning that they can actually be traded in the middle of the day. You don't have to wait until the end of the day to see what the NAV is. Is that a good thing or not? ETFs' purported advantages are easy diversification, meaning that you've got all these basically indexes, and so it's easy to construct an asset allocation with the proper diversification, as if any participant knows how to do that or knows what the proper asset allocation is. But you as the financial advisors registered investment advisors, IARs, and so forth, you can create portfolios using ETFs. There's generally very low expense ratios. There's purported tax efficiency of index funds. And then there's the transparency, which is kind of important in the new evolving 408B2. Let me bring up another poll, and let me ask you this question. Let me launch it. The first ETF, which was a SPDRs, became available when? Do you think ETFs have been around since 1974, 1981, 1993, 1999, or just recently in 2005? So how long have these puppies been around? And, you know, it's certainly much more recent that they are becoming a subject of discussion for 401k plans. So looks like a few of you are going to learn something new. So when you're discussing ETFs with your clients, you'll have some information for them. And we'll go ahead and got 80% of you voted. Now let me check over here and see who's not paying attention. Whose screen is not their primary screen? Oh, I see 3 or 4 of you. Doug, good for you. You're paying attention, and you voted, I'm sure. So let me close the poll, and then let's share the poll. Hopefully you can see it, but I'll drag it over the screen if you can't. And so 58% of you are betting that ETFs have been around for about 18 years. A lot of you feel like maybe they're a little bit more recent than that. So maybe your awareness. Nobody thinks they've been around since 1981 or earlier. So let's hide the poll and then get it out of the way here. And then let's talk about a little bit of history. The genesis was basically in 1989 with a thing called the index participation shares, but that's not really a true ETF. It was an S&P 500 proxy. It was traded on the American Stock Exchange and the Philadelphia Stock Exchange, but it was around for a very short time because the Chicago Mercantile Exchange got jealous and they sued them, and the SEC made them take it down. So, however, SEC doesn't mandate in Toronto or Canada, and they had a similar product in Canada that U.S. was watching, and it was very successful, so people here wanted it. So the American Stock Exchange executives, Nathan Most and Stephen Bloom, designed and developed a Standard & Poor's depository receipts in January 1993. So the 58% of you that said 1993, you were correct. That's how long they've been around. They were known as SPDRs, and they actually at one point were definitely the largest ETF in the world when there were a bunch of ETFs. And then also they introduced, since that went over so well, they introduced 2 years later like a mid-cap SPDRs. Okay, Barclays Global Investors, they entered the market in a big way in 1996 with what were called World Equity Benchmark Shares, or WEBs. Well, that's not a very marketable name, I don't think, and so they were subsequently renamed what you're familiar with called iShares, and that was to track the Morgan Stanley country indexes. There were 17 of them at first. Okay, well, and then it continued. You know, State Street brought out SPDRs for the sectors of the S&P 500. Then we had the Dow Diamonds in 1998. Then the Cube for the NASDAQ 100 in 1999. To me, when I saw this history, and basically I looked it up on Wikipedia, I was kind of like, hey, this stuff is fairly recent. And then started being promoted heavily, and that's why people are asking for it by Barclays Global back in 2000, just 11 years ago, and so they've done a really good job of promoting it. So good, in fact, that BlackRock bought them in 2009. So I read something that said that in this month, 40 new ETFs are coming to market, and that's pushing the total, I think, of U.S.-based ETFs to some 1,300. not all of them survive and stay around. I mean, they come out with a concept or an index or a sector that they're going to follow, and they hope to raise money, but they don't have the marketing or exposure or whatever, or the big boys beat them. So there's a lot of concentration in just a few large suppliers of these things. Ron Rowland's ETF Death Watch newsletter suggested that 10% of the ETFs are in danger of shutting down. So, and that's basically because they just have not attracted enough money, and there's a certain, obviously, expense level at which you can run these things. So why do participants want them? Well, they read that they're very low cost, maybe even lower cost than a passive index fund from Vanguard or somebody. They are they've read many articles and ads telling them that they should want them. So people always want what somebody else tells them they should want. Oops, sorry, I got a telephone ringing. The pleasures of working in your office at home. So they want them, you know, just because they're told they do, and some of them think they want them because they really are disguised day traders, and so they really want to, if the market's going to panic, they want to take advantage of that. Now let me ask you how you feel. Let me open up another poll. The poll is, should participants be given the ability to trade midday, you know, using ETFs? Is that a good thing? So let me launch that. And how do you feel? Is this an advantage, the ability to actually sell your ETF in the middle of the day? Because you wake up, you listen to the radio on your way to work, you find out that the market is down, you know, some 400 points, and you can't wait till they get to the office to liquidate your investments. So, yeah, well, you're professionals in the business. You understand that this is long-term investing, so I'm going to go ahead and close the poll. I can see how most of you are voting, and so let me share it. I'll drag it over in case you can't see it. So of the 80% of you that voted, you know, 83% of you said no, that will further aggravate the emotional reaction to a market. And a few of you said, yeah, they need that ability to trade. So you're believers that people can deal with it properly. So that's kind of my view. I mean, I can't tell you how many times I, as a participant, have been aware of something going on in the market, and then I wanted to, or maybe wanted to pull the trigger, but yet, you know, I wasn't sure how much further it was going to go down, and then I didn't want to necessarily go on to pull the trigger because then it was just going to be a disastrous day, and I didn't want to sell out at the bottom, you know, necessarily. I wanted to study a little bit more. So not being able to trade in the middle of the day probably kept me from trading, and therefore, you know, I gathered more information, and I gathered control of my emotions, and I decided maybe I shouldn't trade, and then, you know, next day there was a recovery and so forth, and you know, I start studying the market and everything and see that, hey, maybe you should take a long-term view here. Well, why do plan sponsors want them? Well, if your participants are asking for them, what are you going to do as a plan sponsor? What do we mean by plan sponsor? That's usually a person. That's a human resource person listening to people. That's a that's, you know, somebody. So committee, I mean, they're real humans. The human resources people and the CFOs, they read articles too. They perceive them as very low cost. They perceive them as transparent, which certainly they are. And other advisors are calling on them all the time. If you're not, asking them if they have ETFs. That's a door opener, folks. So I got about 4 more minutes, so I was going to do some, show you some websites and stuff relative to ETFs, but I'm just going to go ahead and finish the presentation because, again, we want to keep our promise of getting you out on time. So why do the financial advisors or the RIAs like ETFs? Well, it's, if you're going to construct, you're in one of the platforms where you're going to construct a portfolio of people, then maybe, you know, you're not going to be looking at actively managed things, although there are going to be actively managed ETFs now. But, you know, anyway, it's a convenient way for you to construct an asset allocation models for their participants. Certainly it's low cost. There's a, if you did a Google search for Yahoo ETF, They have a very proactive website, and you can actually go in and click on a button called Operations, and then you can sort all of the ETFs. I was amazed to see one ETF where the expense ratio was 3.11%, and then I saw another one like 1.8. So do not make the assumption that all ETFs are at 6 basis points, because they're certainly not. You know, I think you ought to decide whether or not this is a real trend that has real advantages, and then decide if you want to appear more advanced, and then start asking your wholesalers or asking our guys helping you get proposals whether or not that particular platform can accommodate ETFs. When you're in front of that committee and you've got 3 or 4 proposals and the question comes up, I think you certainly ought to have one of your proposals ought to be one that accommodates this request. You know, some of the disadvantages might be trading costs. I went online last night in my 401k, went to my self-directed broker account, and wanted to experience purchasing an ETF. And the first thing I ran into was, and I was doing I think it's VOO, which is the Vanguard S&P 500. And the first thing I ran into on TD Ameritrade when I went to buy was I get into a bid-ask issue, and it said, okay, the price is $56, but you know, one of the bid and ask were 50 and 60, and so immediately it's like, whoa, you know, and you know, I kind of understand that stuff, but what about the average participant who has no idea what that is? So I think they could get confused. And then there's, I know some of the vendors have dealt with the whole shares versus fractional. Participants want to be able to sell exactly $5,000 or buy $5,000 worth of stuff. That's not necessarily going to be whole shares. As far as record-keeping vendors that accommodate ETFs, what you got to understand is that they're not asleep at the switch. They're watching the market. They're seeing what others are doing. They're seeing what people are asking for, and so they keep up with the times, and they look for ways to accommodate trends. So anything I would tell you today about which vendors have ETFs available in their thing may not be true tomorrow. So our guys are always on top of this as far as getting proposals all the time, asking those questions, and so they build up a pretty good knowledge of who's adding ETFs to their platform and who's not. So, you know, and when you're pursuing the prospect, make sure you kind of find out if ETFs are important to them, so you then go get the right proposals that can accommodate that. So anyway, if you want a lot of ETFs available in order to construct portfolios, then what you probably will need to do is look at an open architecture vendor. That would be somebody like a Census or Aspire. They all work with TPAs, by the way, so just because you're going open architecture doesn't mean you don't that you have to leave a TPA out. And we give you another whole speech about why I have a TPA versus bundled, which is a different question. But anyway, open architecture would be the way to go. But make sure you find out if they truly are offering you this or if there's any restrictions. And then you got to remember that if you're not an RA or an IAR and you're doing open architecture, you know, there aren't any 12B1s generally in ETFs. And so if the only way you can be paid is through 12B1s, then you're probably going to want to find another platform where there's some sort of a wrapper that takes care of your commissions and takes care of what would normally be the revenue sharing for the vendor. Okay, another way, of course, is to through self-directed brokerage accounts. But of course, that's not going to lend itself very well to RIAs constructing portfolios, because you can't construct portfolios within those self-directed brokerage accounts for those participants. You're generally dealing with a core account and so forth. Well, I have one more poll, but I'm not going to do it. Let me finish up here. I think it's an evolving trend. I think it's fairly recent, so you behind 2009. So how many plan sponsors have changed their plan since 2009? You've got Invest and Retire who uses all ETFs. And they've been doing it for a while. So there are platforms out there that have been it for a while, but I don't think you're behind the curve yet if you haven't been promoting it. It's certainly doable. All right, well, we'd like to see you next time. We got a webinar on November the 9th on advisor compensation in the 401k world. We've got our live 401k Academy event on November the 8th in Mountain View. Here's your names. Remember, you can always go to 401kacademy.com and click on sales support and pick up this information. But our external wholesalers, as we call them, or our sales consultants who are also vendor analysts, they are Tariq Jones and Chad Johansson. You can call either one of them, tell them where you are, and they'll tell you if they're the right one or based on territory if you should talk to the other. So they'd be delighted to help you get proposals and do point of sale and do analysis. And one other thing, we are right on the verge of putting our webinars on YouTube, and there will be links on the Academy website, so that if you ever sign up for one of these webinars and you cannot make it for some reason, or you want to see what other topics we have, or you missed the earlier ones by JD on the sales proposal stuff, you'll be able to get to those to YouTube on our website. So thank you very much for attending. If you have any questions, please send those via email to jd.carlson@plandesign.com. We look forward to being your partners in the 401k world. We think we're skilled at it. We think we're very helpful. I think we're very nice people as well. And we believe we can bring a lot to the table for you. So thank you very much. Have a great day.